Well, joining us now for an exclusive interview to explain what's going on at the bank is Standard Chartered CFO Andy Halford. Makes sense of that 6% drop yesterday.
Well, I think one needs to see it in the context that actually the share price had run up quite strongly in the 4 or 5 weeks immediately before that. So actually, even at the end of yesterday with a 6% fall, the share price was up 20% on the year so far. So I think it is just sort of ebbs and flows. There were clearly a couple of questions, some people expecting a dividend, which we said not yet, and therefore maybe some a little bit disappointed by that. But overall, I think the progression on the share price has been pretty strong this year, but yesterday clearly it came down and corrected to some extent.
Dividend not yet. Dividend this year. Give me probabilities. 50, above 50, below 50?
Well, 100% it will be reviewed at the end of the year. No, we said that really there are two things that are important for us. One is we're comfortable that there is a profit stream and an earnings stream, which is going really well. We announced nearly doubled profits. But the second one is making sure there's enough capital. And there are still a number of things out there in the regulatory space, which we think will become clearer over the next few months. And therefore, the decision was that we would make a decision at the end of the year when we have more clarity on those fronts.
One of our analysts at Bloomberg Intelligence sent me a note saying capital levels at French banks are far lower, but they're not citing Basel IV and regulatory uncertainty, but they are promising 50% plus payouts. Why is your outlook so different?
Well, I think the difference actually is a slightly different one, that for other banks who have been paying regularly dividends, their decision is merely one of a continuance of a dividend. Whereas our situation is a little bit different. We did stop paying the dividend a while ago, and the decision to recommence it is one that we want to make confidently, and when we do make it, we want to know then that we can confidently continue to pay it going forwards. So I think it is purely that we are in a slightly different position. Frankly, all of the banks are trying to work out exactly what Basel III, Basel IV will involve, and none of them, I think, at this stage have clarity.
What does Basel IV then mean for capital for you in the worst case scenario? Can you give us a figure?
It is just genuinely very difficult to say because there are a number of different things that are being looked at, and it is not clear at the moment which of them is actually going to be the one that the regulators will decide to go with. And there is a lot of detail that is still being talked about. So until that is clearer, it is just.
What about for the industry
really
itself? I mean, some estimate that the rules, along with new accounting standards, could add hundreds of billions of dollars to banks' capital buffers. Is that a fair guesstimate?
Difficult to know. I think that there are many different estimates out there. The governor of the bank has said overall we do not expect this to have a significant upward increase on capital across the sector. Clearly that leaves open to definition what is significant, and the sector as an average there may be outliers in that. But really until there is more progress on the discussions, just genuinely a very difficult question to answer.
I must read you a line from another analyst, Andy, if I may. We think Standard Chartered aspires to be seen as a growth story rather than a dividend play, but at present it's neither. So disappointment on the dividend. Where's the growth going to come from?
Well, I would look at it slightly differently. So we have a bank that 3 years ago did hit quite a number of troubles, and we have spent the last couple of years actually working our way very carefully through those. I think we have made a lot of progress in that period of time. The balance sheet is a safer balance sheet. The quality of the lending is a higher quality of lending, and we're just starting to see the earnings pick up. So we announced for the half-year profits broadly double where they were a year ago. And clearly you get to a point where people are hoping that the profit's going to increase. They want the dividends as well. And we're just sort of midpoint in that turnaround. So at this point in time, the earnings are there. Ultimately, with strong earnings will come dividends.
But even Winters says, the CEO, that income is relatively modest. So when can we expect a pickup from this relatively modest pace?
Well, it will be a progressive thing. So we showed that the income has picked up in each of the last 2 halves. In fact, in every quarter since we did our strategy update in late 2015, it's picked up. I don't think this is something that happens overnight. There are a lot of different things that we are doing which progressively will help to pick the income up. But the direction of travel is good, and the overall profitability is improving, and I think we're confidently back on a good track now.
So it's all about a path, the pathway. What about the pathway to a decent return on equity? The chief executive dumped the 8% target. What's reasonable in the near term?
Okay, so to be very, very clear, the 8% target is absolutely not dumped. It is still there today, and it still remains.
Right.
What we did a year ago was said it was difficult to put a precise timescale on it, but absolutely we want to get to 8%, and indeed we want to get beyond that, because that will be covering the cost of capital.
So it is still in place. It is still in place. There just isn't a time on it.
Absolutely in place.
So what's realistic then? I mean, because you won't, I guess, give me a time. What's realistic over a year or two?
Well, let us put it this way. We were 2 years ago with a slightly negative return on equity. The numbers we announced yesterday were about a 5% return on equity, although they are in a half year when we do not have a bank levy charge. So at the end of the year, we'll have a true up on that. So we are more at the 4%. So we are on journey. We started at 0, we're trying to get to 8, we are now at 4, and the progress, I think, over the last 2 years has been pretty phenomenal.
The outlook yesterday from the chairman and the CEO, you'd have to say, was rather cautious. So which geographies, which asset classes would you say you're most worried about? I mean, the outlook geographically is mixed. Revenue dropped in all but one of the regions. Greater China, North Asia has a plus sign in front of it. So which asset classes, which geographies are you most concerned about right now?
Well, overall, the revenue increased. So even if a couple of the markets went down, the biggest single market for us, Greater China, went up. So just to be clear that we did go up on the income. I think over a period of time, we see very strong growth in the Hong Kong region at this point in time. It has been a bit more subdued for us in the Middle East and in Africa recently, but some of that is because of currency effects, and those may turn around over a period of time. But broadly, we have been growing across all of our client groups over the last year, and we see that progression continuing. I think it's also worth noting that we are very Asian-based. Many of those economies are growing, and many of those have got a financial services sector which is growing, which is a nice position to be in relative maybe to some other parts of the world.
And in other parts of the world, in the US. And would you say the Trump presidency has hindered at all your ability to grow your plans, your ability to grow in the United States, or not?
No, I don't think it has hindered our growth there at all. In fact, if anything, we are focusing slightly more of our energies in the US, because we are very clear there are a number of US corporates who have got interests in Asia in particular who do not bank with us. And actually, we have put more resource into the US just recently so that hopefully we can sell more into a broader range of corporates in the US.
Let's talk about the UK. I know it's small, but we're here, so we better do. We better talk about Brexit. When will you start moving some of your people over to your new EU hub of Frankfurt?
Yeah, so we have decided that Frankfurt is where we will base our people. We already have an existing business in Frankfurt, so it is a logical extension. It is not for us going to be a significant number of people, because actually the UK and Europe is a relatively small part of our overall business.
Or in the hundreds?
In the tens.
Right.
In the tens.
So the cost is minimal.
Cost is pretty minimal for us relative to the size of our business. It is a bigger issue, obviously, for some other banks who are more Europe-centric. So for us, it is something we will do over the next couple of years, but it is not a big issue for us.
What's Brexit going to look like in 2 years? Get your crystal ball out. What's Andy Halford's crystal ball telling us?
Well, I suspect there are going to be a number of pragmatic compromises that will have had to have been reached at that point in time. Because the number of topics that are still in the air at the moment, some of those are going to have to get landed. Some of them are complex, some of them will take time, and I sense pragmatism at some point will start to prevail.
Yeah, it's BOE rates day today. I'd be foolish not to ask a CFO about the Bank of England on Super Thursday. They did nothing. They cut the growth forecast, they cut the wage forecasts. They said the market's maybe a little bit too dovish when it comes to rates. Andy Halford's first UK rate hike. When?
Not for quite a while.
Right. Is that a year or two?
I think that is a year or two.
That's good, Andy. Great to see you. Thanks for joining us today. Standard Chartered CFO Andy Halford.